Okay, good morning everyone. We'll start our lesson 5. Today lesson will go through LO5, learning outcome 5, be able to critically appraise investment option. So today lesson will go through appraise. Appraise always is meant by checking the performance. Appraise something, you always checking the performance. So we appraise where we'll invest, how much we invest, when we invest. Is it good to be investing project A and project B? We have a two options. So always be looking. So that's we'll go through today lesson. And today lesson we have a three command words, the things we supposed to be there. So please you can mute your end. It's a background noise. Someone. Command verb assess, offer, reason, judgment. When we'll say reflect and appraise, which we'll go through, that's the command verb, and justify. If somebody say justify to you, you present a reason, case for action, other decision making. That's the justifier. So these are the key command words which we're supposed to. And today lesson inductive content is about sources of financial resources, types of funds, short-term, long-term, internal, external, capitalized, all this is that you should lesson. Okay, so before starting today's lesson, let's recap what we learned during our previous lesson. Okay, so let's recap what we learned in previous lesson. So anybody remember what we learned in lesson 1? Do you remember? We learn about costing systems, or we can call costing methods. We learn about ABC. We learn about absorption costing. We discuss about marginal costing. We learn about process costing. We discuss cost centers. We discuss direct and indirect cost, behavior of cost, like fixed, variable, and what else? Okay, so these are the key things we learned lesson 1. Anybody remember lesson 2? What we learned lesson 2? We discussed, yes, well done, thanks. Peter, is financial statements. We discussed balance sheet. We discussed statement of comprehensive income. We discuss about profitability, yes, which is an income statement, also known as, and we discuss cash flow, and we discuss statement of, well then that's we call statement of cash flow, and we discuss statement of change in equity, and we discuss ratio. Do you remember lesson 3? What we learned? Lesson 3. Lesson 3, we discuss budgets. We discuss types of budgets. We discuss excellent budgetary control. We discuss variance. Okay, anybody remember lesson 4? Well done. That's we discuss variance. Yes. What about lesson 4? Anybody remember lesson 4? What we discussed? Last lesson. Lesson 4 was, what was? We discuss short-term and long-term sources of finance. Yes. So lesson 4, sources of finance, short-term, long-term. Excellent. Even we discuss medium-term, good, long-term or more than a year, short-term or less than a year. Okay, medium 1 to 3, and long can be more than, or even long can be more than a year. Yes, we discussed return profit. Good, that can be source. Return profit, where you can raise money. We discussed equity and debt finance. Yes, we discussed debentures. Can be. We discussed bank loan. We discuss shares and various options we discussed basically. So we said always do cost and benefit analysis of each source. Benefit analysis for each source. Yes, then you decide which one is best for you and for how long you want borrow money. So that's all we learned during our previous lesson. That's a recap what we learned in the during our previous lesson. Okay, guys, current your knowledge about sources of finance. We discuss, apply. Okay, so today is really is not changed properly. What current knowledge about appraisal methods? Okay, let's please. Anyone knows appraisal methods? What is meant by appraise? Have you ever done the appraisal? So 1 to 10, what do you think? Where we up to in terms of appraisal knowledge? What do you think? You're on 5, you're on 6, you're on 7, 9, 10. Where we up to? 4. Anyone else? Okay, so we saying 4, 5, some. So so appraisal.
How would you know if there's a plus 500?
So appraisal, anybody know 360-degree appraisal? Appraisal always equal to performance, and performance we check in time, in cost, and in quality. So when we decide something, performance of for someone or some project, so we have in our organization we use the 360-degree. It means appraise someone's performance. Not only senior and junior, 360-degree is the whole cycle. Your colleague, your subordinate, even cleaner, even outsider, they will give views about yourself and all the points we add into the system. And this is 360-degree appraisal method. Normally we use in HR. So here we're looking appraisal in terms of project, financial. Yes. So financial appraisal. You invest in which project? Financial appraisal. So that's we'll go through today. So key method we have payback period. Payback period. How long will it take the money we invest will recover the money back. Second method is net present value. Okay, so in this method, the pound or the money we have today is more value the pound will get in future. So we depreciate because the values depreciate. So if you have a NPV positive, accept project. If NPV will come our figures negative, so what we'll do, we reject the project. So that's the accept and reject will do. IRR, internal rate of return, one other method. If you have a high accept, and low reject if you're comparing two projects. So then second, so we have a payback, shorter is a better, quick you get money. NPV positive is a better, IAR higher is a better. One is called ARR, is called average rate of return. This is internal rate of return and this is average rate of return. So average rate of return higher is better. Yes. So we accept, normally if we are comparing two projects we have, and always we compare with the bank interest. If the bank you deposit money, they will give you more, so no point to take the risk, to invest in money into different projects because project is more risky, and you higher the risk in business we call higher the risk, higher the beta risk factor, it should be high return, and which we discussed in Bitcoin in the previous lessons as well. Okay, we'll go through. Now today's lesson is investment appraisal, and we're looking first 5.1. Apply financial appraisal methods to analyze the completing investment project in different kinds of organizations. So that in your assignment is a better, because next lesson will be assignment discussion session, and in investment appraisal we can use different methods. The most objective of the investment appraisal is to maximize the shareholder value, because the project will maximize the shareholder value. The value of the shares will go up, not go down. That's the key objective. Most of the decision-making companies, directors have a duty to interest their shareholders. Research has found, develop the decision metrics that's a maximize the shareholder value. Cash is a preferable to profit. Cash, because you can do credit sale but you not get the cash, so what's the point? You selling and buy now, pay in 10 years, and you don't have a cash. How you will sustain in a business? So some company, they do prefer to be profit, not just sales, credit sales, and profit in cash. Exceeding the cost of capital. Exceeding what costs you exceed it. Yes, what debt you borrow and what costs you, and you're getting more return. According to the Peter Drucker, which is one of the great scholar, Harvard Business School article, unit of the business return, profit is a greater than the cost of capital. It operates at loss, never mind. It pay the taxes if had the genuine profit. The enterprise still return less economics than the resources deploy really, until does not create the wealth, it destroy the wealth. So we need to be look around, we create the wealth. Okay, next we're looking managing short and long term perspective. Short term and long term, you always think share stock plays the value on the company's future potential, not just the current profit. Yes. So company announcement about capital expenditure. Capital expenditure is mean buying the shares. Revenue is mean maintaining the asset in the same condition. So revenue expense goes in the profit and loss, and capital expenditure goes in the balance sheet, which is mean your asset. Okay, so that's so positive, then negative factors. So we need to be announcement, maybe have a short term effect on the profit, but the long term, like a biotechnology company, you investing in technology millions, this time will be negative cash flows, but in the future will be bring the more cash flow. Today investment. Okay, this is all about. Next we're looking the time value of money. So think about, so in NPV we'll always looking time value of money. The pound today is more worth it, the pound will get in a 1 year's time or 5 years time. So long term invest, maybe you can argue no in foreign exchange, we're not really looking the foreign exchange in our own exchange. So most of long term investment take in account the time value of money. So in a project, if one project give you quick money and one project give you more than the depreciation because the value drop, which we use different discount factor. Recognize the fact that the money paid out and received now is worth more to us and expectation of the same amount in the some future dates. So it is due to the following investment opportunities. Think if you have a cash, you have a more investment opportunities. So money received now. Can you hear me all? Please, if you have any question, you can ask. Huh? So invested and grow larger sum in the future. Cost finance. Always keep in mind if you borrow the money, how much interest you have to pay. The money received sooner could be used to repay it and save the interest. So that's, we can. Inflation. Purchasing power of money 100 now and 100 in 5 years will be more today than due to the inflation, because inflation means the persistent increase the price index. And one we call use the word hyperinflation. Hyperinflation mean more than 10%. Those countries have a more than 10% inflation, we can say is a hyperinflation. Normally hyperinflation has country in crisis. Huh? Otherwise not. Some countries is going that happening. Okay, risk. Future cash flows are less certain. The implication of this can be significant, particularly for the long project. The time value of money is reflected in the techniques. These NPV, IAR, MIR is called marginal internal rate of return, and discounted cash flow or cashback, or we can normal cashback, which I'll explain you in the further slides. Okay, appraisal. So what is a investment appraisal? Is a business concept which expect the future cash flow and derived. Yes, and it's all about the techniques. Investment appraisal to look the potential capital investment by firm, measure the potential value of the firm. Value should be increased. Therefore, the method of investment appraisal is different and allow the potential risk and return always be doing. Different authors explain slightly different. Okay, so what we're looking, let's say you want to make a decision to make it or buy it. You can manufacture, so you have to make the decision. If you manufacture yourself, what benefit you have? If you buy from abroad, anybody heard about social accounting? So with respect, if everything we buy from China, so what will be happen? Local jobs. Yes. So we have to think about what effect will be happen on the local jobs. So make internally or contract out. Comparison of relevant cost different in unit of variable cost or any directly attributable fixed cost. So that's always we need to keep in mind. Segmentation. Segment is mean small proportion of the business are different. So we can segment into different period and different effect, that can be happen. So all this we can make decision. Either we invest, we go, we don't. Okay, discounted cash flow. So discounted mean the pound is not really £1. We can use the discount factor. Okay, which we'll go through in the next slide to furtherly explain you. PV is the present value. Net terminal value, it's mean, net end project, what value will be. Net present value of the project life cycle. Throughout the project, project life cycle have, introductory growth and then, the maturity, and they reach the product life cycle as well. Okay, so this is, we'll go through. This is, we have, okay, you will see here, this is, we are investing 100,000 in the project. This is the money is out. Year zero is mean current year. In current year, we are investing 1 100,000, and we are getting back year one. We have inflow cash coming in into business 20,000, 40,000, and 80,000, and we are using one factor which is called present value factor, or we also use the discount factor, DF, discount factor. So please don't need to be worried too much here. So PV is the present value. So what you can, if you normally we use the discount factor table, but you can use it yourself. 1 divided by 1 plus R. Okay. R is mean discount factor. It can be 5, it can be 10. You can look around various factors. Like if we have a high inflation, 12% inflation, but if you deposit in the bank money, bank give you 8% interest, so 12 plus 8, so you can say you depreciate the money into 20. If you have a return more than 20, then you have a real return. Otherwise, you don't have a return. Yes, because if you're getting 20, 20 is just meeting your interest and your inflation. So you're not really gaining. So let's say if we have a 10%, one is in the formula, one is a today value. In a current year, £1 is a £1. 1 plus 10. What is the 10%? We can write 0.1. Yes. So can you divide 1 divided by 1.1? Can you? Let's guys, can we divide? So 1 divided by 1.1. So if you don't have a discount table, we can discount ourselves by using this formula, 1 divided by 1 plus R. So these two ones in the formula, R is a discount factor. It can be 5, it can be 10, it can be 20, it can be 30, whatever discount factor you want to use. So if you look here, 1 divided by 1.1. So in my year one, 10% will be after depreciation 0.09. So actually what will be happen, your £1 which we investing in year 0, in £1 in year 0 is 1, but after 1 year this will be depreciated to 0.909. You can say in rounded it's 91 pence. Yes, whatever answer will come yours, divided by 1.1, which is denominator figures. Yes, because 1 is in the formula and 0.1 is 10%. So this is after year 2, the £1 will be only 82 pence. So year 3, then carry on dividing 1.1. So year 3 will be 75 pence. Yes. So now this is our discount factor. So if you investing 10,000, that's outflow. That's why we're using the negative sign here. In bracket in accounts we use negative, or you put the negative sign, is the same thing. So this is the outflow. If 100,000 multiply with 1, it's 100,000. If you're getting 20,000 back after year 1, you're saying, oh, I'm getting 20. No, you're not getting real money. You have 20,000 in your hand, but that give you 20,000 value. In real value of that money is 18,180 pounds. Then year 2 and then year 3. So if you add, you carry on. If you're getting 80, multiply with the discount factor, you're getting actually 60,080 pounds. So I'll add all my positive figures minus negative, and what is my net? If my positive is more, we accept the project. NPV, net present value, is a positive, we accept the project. If we have both project A and B, for suppose we are comparing, if A has the more than the B, then we'll go for A according to appraisal method. Can you hear me all? Anybody any question, please? If you not get me. Anyone, any question? Yes, no? Okay, brilliant. So that's the way we have to do. Okay, in our assignment as well, we need to discuss these. What is investment appraisal and method? We can. Okay, so payback period. Payback, if you invest today, if you get quicker what you invest, you can say, oh, at least whatever I invested, I cover. I might break even. If I not get profit, but at least I not bear the loss as well. So payback period shorter is a better. So we have an advantage for this method. Is easy to calculate, easy to understand. Consider the thing cash flows and the firm operating makes undergoes cost changes. It's quite good. And some disadvantages, don't consider the time value of money. Don't need to be calculated after the meeting the what you invest, that. So let's see here example. We are investing 3100 in year 0. Year 0 is year not today, current year. And then we are getting return 1900, 800, 500 in year 4. Say yes. So now this is a cumulative. Cumulative mean total. So you invested 31, you got 1000. So outstanding amount minus inflow, and what is the remaining? So 2100 is outstanding. End of year 2, you have 1200 outstanding. End of year 3, we have 400 outstanding. So we have a 400 left to recover end of 3 years. So we can say this project will take 3 years and some months. We don't know how many months. Yes, so end of year 3, outstanding amount divided by the following year inflow and times by 12. So if you do outstanding amount, how much outstanding? Because in the following year, we are getting money more than what we have outstanding. So it means it won't take 4 years full. It will take less than 4 years. So outstanding amount 400 divided by following year, which is year 4, 500 you're getting. So that's why it won't take 4 years. And how many months in a year? Times by 12. So we can find this will take 9.6. So we can say if we are doing in monthly basis, so we can say this project will take 3 years and 10 months. So if other project B will take 2 years, so we'll go for B, not for A. So that's the way we can calculate payback period. Anybody any question here? Payback period? Okay. Then again, NPV, we have advantages, disadvantages. Okay, then this is one other example. NPV, we are investing, we have a present value factor, which is discount factor, and we found it. So you can add it all these positive minus negative and decide either is it go ahead or not. The next method we are using ARR. ARR is called average rate. There are few other methods as well, but we're not really doing every method because as a part of our assignment and the syllabus, really we're just looking at least some methods. So accounting rate of return, which is ARR, average rate of return. So what is the average? Average profit. If you're getting £100 in 5 years, so what will be your average? 100 divided by 5. So average is 20 per year. Yes. So that's why we find average. Time by 100 divided by initial investment. If you invested 1000, so 1000 divided by 20 divided by 1000 times by 100. So you can find how many percent. So which we'll go through example here in R. So we have a project. So we have 3 projects. Andover, Bristol, and Carlisle. We are investing in the project Andover. So think about we investing 4 million, but we are getting return 1 million every year. So in 5 years we got, if you add it, 5 million, and you invested 4 million. So profit is 1 million. 1 million divided by 5, we getting 0.2 million. 0.2 divided by 4 times by 100. So we getting average 5% return. Yes. And then you do on Bristol, we getting 5%. If you look, if we investing, if we choose the Bristol and hand over these two projects. So you look, both give us 5%, but which one is the best, A or B? Because in A we'll get in year one 1.5 million, 2.5 million, then we'll get 0.5, 0.5. In the year 5 we get nothing, yes, but overall we'll get 1 million. Yes, we divided by 5, we get 0.2, and average will get 5%. So what do you think in A and B, which one will go? Leave for C. If you have a two option projects A and B, which one you will go? Both required 4 million investment, both give the same percentage of return. Which one you will go? You will go for A or B? B. Okay, good. Yes, you're right, because we'll go for B, because in B you getting the quicker return. Your average is the same 5%, but if you use the compound interest, so it means you can reinvest the money and you can multiply it, yes? So that's the way. But if we look project C, which required 5 million investment, first thing, if I don't have a 5 million, I can't go for C really. If you look there in year 2, we're getting 0.5, then we are getting, and then the difference, yes, what you getting minus your out, you're getting 2 million divided by 5, you're getting 0.4 million, 0.4 divided by 5 times by 100, so we're getting 0.8%, 8% return. So which one you will go now? If you compare A, B and C, which one will you invest now? What do you think? Will go A, B or C? Which one is best? C. Yes, you're absolutely right. C is the best then. A and B, because the C is a high return. Only the problem in C, if you don't have investment 5 million, you don't have a money for to invest 5 million, so you can't really go for C. Yes, but in C you have to wait, then you get the later years you get higher. So that's the way we can, and then we have activity you can do. You can calculate the payback, project A and B. Even in the assignment you can say assume it, you can't find the figures, you can embed in your writing, which we'll go through in our assignment discussion, and you can look around, yes, ARR or whatever, so that's the way. These are extra examples which you can calculate. Okay, so a plan to express in money, and you budget where we are. Always keep in mind the budgetary control. Next we're looking, and thus we can appraise as well which budget will give you higher. Okay, I copied the link for you here. Yes, so always we focus on 3 M's: men, money and material. We always look at responsibility. If you give more responsibility, you need more budget for it, and the budget and the difference is the variance. So I copied the link of the case, you can read, which you can, if you want to use it first. Okay, example in your assignment. Okay, 5.2, justify the strategic investment decision. Strategic mean the long term investment decision, either to invest. So business face many different types of decision, range from the strategic choices in the long run. You want to go in the new market, you want to invest in the new product. Operational decision, which is day-to-day operation, is mean the day-to-day operation, marketing, HR. These are all our operation, and these overall operations make our organization and return. Always we looking the performance of our organization. Solving such a decision problem, quantitative and qualitative data are the factors we can use. Quantitative mean numbers and qualitative mean good, bad qualities. Okay, so many different techniques we can use, and decision making means selecting the best course of action. So we discussed management in lesson 1. Management is a process of designing an environment to achieve the pre-selected objective. Yes, pre-selected objective. Managers always try to create a surplus. Okay, so long-term decision, short-term decision, discounted cash flow, contribution mean return. Decision making in the limited scale resources. Scale mean we don't have unlimited resources, we have a limit. If we have a staff, we have a HR, we have a money, all these are assets. We don't have unlimited, so we need to use them effectively. Maximizing shareholder wealth, as earlier we discussed, our business objective can be maximize the shareholders' value of the shares. Exceeding the cost of capital, always our objective to exceed the cost of capital as a business, and which we discuss, Peter comments on it. And then user of financial statement. There are different user in the financial statement, and the financial statement also reflect the performance of the company, and different people make different decisions, like we discussed in case of Anika and Papika in second lesson. Yes, and user we discuss. And then we have financial information and financial ratio. We can use it. Yes, and we can each ratio we can interpret what is the meaning to measure the performance of the company, because this is appraisal. So appraisal is the what is an investment appraisal, and one is already you have a data and you use the ratio to measure the performance. So that's we can look around. Okay. And then we have little quiz, which is investment appraisal. So we'll go through together today this appraisal method. It's sort of quiz. So through quiz we'll try to learn and enhance our understanding. Can you see all? Okay, let's guys participate. Okay, let's please. So an investment costing 250,000 and expecting to generate total return 4 to 5,000 over 5. So what is the ARR? So you do what you invested, what you getting, the difference is your profit. Yes, and find the percentage. What will be as an average? What do you think? Will go A, B, C, or D? Yes, guys, which one you think? Don't worry, what you think? A, B, C, or D? So think 250 you invested for 425 minus 250 divided by 4, you get average profit. Average profit divided by your initial investment times by 100. So which one will be? Can you hear me all? Yes? What do you think? We'll go for one. We'll go for A, B, or C, or D. Let me know, please. Don't worry if right or wrong. 1, A, B, C, and D. Average rate of return. What is the average rate of return as a percentage? Which one? So B. Yes, which is correct. Yes. Even the word indicate average rate of return because you're getting in the percentage as we seen in. Okay, what about next? The following advantage of payback method. Payback, what we said. Except which one? Which one is not advantage, all other advantage? Relatively easy. Non-expert can say what you invest, what you get. Concentrate on earlier cash flows of the project. It's simple to calculate and take account of all the project return. Which one is not advantage? Which one is payback period doesn't? Payback only is what you invest, what you get. You calculating up to that. You're not calculating. So is the A, B, C, or D? No, what is all advantages? These are all the advantages. One of them is not advantage. Okay, we're saying A is. That's not. It should be D. Okay, next now, investment appraisal. What kind of decision? Is it scientific? Is it hunch, which is based on various exemptions, or is it historical, or is it centralized? Which one? What do you think? A, B, C, or D? Don't worry, guys. Yes, what do you think? Please participate. Just say A or B or C. We're saying A. Yes, well done. It is correct. Okay, if the project has a negative cash flows, then normally what we'll say, we accept, we reject, what we'll do, we postpone. A, B, C, which I mentioned you NPV, if it's reject, well done, is correct. Okay, what is usually considered the simplest method of investment appraisal, which is easy method to calculate? Is it discounted cash flow? Is it payback? Is it accounting or opportunity cost? A, B, C, or D? Which one is easy? A is discounted mean NPV, and payback, what you invest, what you get. And C, anyone else? In C, you need to minus, you need to calculate average, you have to use formula. Okay, no problem, is incorrect. Is a payback period. What you invest, what you get. That's just plus and minus. Okay, discounted cash flow in NPV calculation is a good example of applying the concept of what? Which concept? Is it break even? Is it contingency planning? Is it risk assessment? Or is it opportunity cost? Opportunity cost, you're missing the opportunity, you're taking one. Which one will go? A, B, C, or D? Don't worry. Yes, just even you can guess it. NPV is the net present value, which calculates the real value of money. Well done, is correct. Yes. Okay, NPV of the project can be calculated which formula? NPV, net present value, total project time divided by the total investment, present value of the inflow and cash outflow. Outflow mean the outflow, and present value, which we after multiplying with the discount factor. Okay, so the project return divided by initial investment, or the present value of the project profit and loss. What do you think? Which one? A, B, C, or D? Well done, B is the correct. Okay, next. Which method of investment appraisal not take account of projected cash flow? They're not looking the cash, they only looking the return. Which one? NPV, of course, we look the inflows and outflow. Payback, we look inflows and outflow. Which between these two you have to decide gross profit and ARR. Yes. Which not consider the cash, only consider the profit. Which one do you think? A, B, C, or D? Of course, I said you. Yes, please. What do you think? No problem. Guess it, please. If you don't know even. Yes, because gross profit is not an investment appraisal method. It should be D, which will go through. Okay, next, payback period. Measures. What measures? Is it average return? Is it measure the time when the project reach to the profit break even? And it proceed the cash. It take account the project repayable initial investment. So which one you think? Of course, payback is considered with the time. So which one from B? It should be D. Okay. No problem. Which will go? Okay, sorry. Maybe. What about the potential disadvantage of cash flows? Disadvantage of cash flows. Cash flows is where we're looking inflows and outflows. Yes. What we ignoring here? Cannot be calculated using spreadsheet, taking account the time value of money. That can't be disadvantage. That can be advantage. Ignore long-term return. No, return heavily depend upon the initial cash flow. What do you think? A, B, C, or D? If your initial outflow is more, it will affect your NPV. What do you think? A, B, C, or D now? Don't worry, guys. Right and wrong. Once you said D, who said it D? Someone said, I think so. Maybe for this one, D. Okay, guys, let's please say. Okay, is it D for this? Okay, yes, that's D. So let's will recap. So first was 17 point, yes, which you said. NPV payback period method, it won't take in account of all the return of the project. Is only do what you invest, what you get. So that's why it was the D. Scientific, you said well. Rejected, said well. It's a payback period, which is considered simplest method. Okay, opportunity cost was because this opportunity we missing, which we said correct. Well done, that's correct. And that was ARR. ARR is not account of the cash flow. Is only say what you invest, what profit. In the profit can be credit sale. Maybe you get the cash in the future. Your average return. Okay, this was the take. Payback period, take time taken, project repays and initial investment only. The break even is a point where no profit, no loss. But here we're looking what you invest, what you get. Okay, so that's the all, well done. Okay, so today lesson, guys, we learn about payback period, investment appraisal, different techniques of investment appraisal, and we cover our LO5, learning outcome 5. Thanks for listening. If you have any question, anything, drop me email. I'll try my best to get back to you as soon as possible. So please go through these slides, and the next lesson will be our assignment discussion. I included some activities you can do as well, and in the following lesson we'll go through our assignment discussion. Thank you. Have a nice time. Thanks. Bye-bye.